In this module, we understand credit value at risk, or credit VaR, which measures the maximum loss a portfolio can face due to credit risk over a given time period at a specified confidence level. Credit risk mainly arises from defaults, credit rating downgrades, and changes in credit spreads. While credit VaR is similar in concept to market VaR, there are some important differences. Market VaR usually works with a short horizon like 1 day, whereas credit VaR typically uses a longer horizon, usually 1 year. Also, credit VaR models are more complex because they need to capture default events and rating changes, not just price fluctuations. Now, to calculate credit VaR, there are 3 key components we must understand. First is default risk, which is the probability that a borrower fails to repay its obligations. Second is credit migration risk, which refers to the possibility that a borrower's credit rating changes over time. Third is correlation risk. Defaults are not independent events. During economic downturns, multiple firms may default together, which increases overall risk significantly. This correlation becomes especially important in stress periods. Next, we move to rating transition matrices, which are a core tool in credit VaR modeling. A rating transition matrix shows the probability that a company moves from one credit rating to another over a fixed time period, usually 1 year. Each row represents the starting rating, and each column represents the rating after 1 year. The probabilities in each row always sum to 1. For example, a company with an AAA rating has a high probability of staying AAA, a small probability of being downgraded to RR or A, and a very small probability of default. These probabilities are usually estimated using historical data from rating agencies like S&P. Now, let's understand how we adjust these probabilities for different time horizons. If we want to extend the analysis beyond 1 year, we raise the transition probability to the power of the number of years. For example, the probability that an AAA-rated firm remains AAA for 3 years can be approximated as 0.8985 raised to the power of 3. On the other hand, if we want a shorter time period, like 3 months, we take the fractional power. So, the probability becomes 0.8985 raised to the power of 1/4, which equals 0.9736. In general, the formula is probability over time t equals annual probability raised to the power t in years. Finally, there are some important insights and limitations to keep in mind. As the time horizon increases, the probability of default increases and the likelihood of maintaining the same rating decreases. Conversely, for shorter time periods, default probabilities are lower and rating stability is higher. However, one major limitation is the assumption of independence across time. In reality, rating changes show momentum. This means if a company has recently been downgraded, it is more likely to be downgraded again. So, real-world credit risk is often higher than what simple models predict.